Many investors understand that they can expect volatility in their retirement portfolios, but when the storm clouds gather and they experience temporary declines in their accounts, they're prone to panic. This may be understandable, but the risk of making an emotional decision at a time of market stress can mean the difference between retirement success or failure. In this video, I'm going to walk you through a simple tool that you can use to help keep you on track when markets are volatile. And if we haven't met yet, my name is Mark Walhout. I created this channel to share ideas and concepts that I'm using to help people with retirement every single day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. To help illustrate just how emotionally challenging staying committed to an investment plan in retirement can be, let's look at the historical returns of a balanced portfolio in the United States going back to 1999. And for this, we'll look at a report from the JP Morgan Guide to the Markets. And as you can see, a portfolio of about 60% US equities and 40% US fixed income returned about 5.6% per year during that time frame on average. The average investor, on the other hand, experienced only a return of 2.5% per year. Now, what could possibly explain this difference? Even if an investor is not entirely invested in a portfolio of equities, if they're invested in something like a balanced portfolio, how could they underperform their own portfolio by such a wide margin? And I think that a big part of the reason why is that investors tend to make bad decisions at critical market turning points. One tool that we can use to help us here is a financial plan. But the visuals that we can get from a financial plan don't always do a good job illustrating just how volatile markets can be. After all, in March 2020, a portfolio of 60% equities, 40% fixed income declined by nearly 20% in a very short time horizon. And that can be absolutely terrifying for a new retiree to have to sit through. One tool that we can use to help us get through these difficult times is something called an investment policy statement. An investment policy statement can help us anticipate in advance what's possible in the market so that we aren't surprised when it does occur. It can also remind us of our goals, and in difficult moments, it can help us regain our perspective. So next, we're going to go through a sample investment policy statement. This is built off of an investment policy statement that I use with my clients. This goes together with their financial plan. And the design of this IPS is to be a short and concise document that really tells us the story of what we're invested in, why we own it, and what we can expect from the portfolio going forward. And it is a very valuable tool, especially at periods of market stress when markets are very volatile. I'm going to include a link in the description section below where you can get a copy of this document so you can either benchmark it against your existing investment policy statement or you can use it for your own IPS in retirement. I'm going to go ahead and share my screen. We're going to step through the document and I'm going to move very quickly. There's a number of things here. If you have questions, leave them in the comment section, but really my goal here is to kind of give you a sense of what this document is. I'm going to focus on what I really think are the important parts of it. So the top of the document, fairly simple stuff. We want to identify who the IPS is for, what the goal is that the invested money is aimed towards, the current balance of the accounts, and what we expect to withdraw from the account. So in Janie's case, she's just retired. She's got about $500,000 in her retirement portfolio, and she plans to take withdrawals of about $1,500 per month pre-tax throughout her retirement. The next step is the time horizon. So understanding the time horizon for the investments covered by the IPS. In this case, it's Janie's retirement. We expect it's going to last about 30 years. Next is asset allocation. Janie, again, this is a sample client, but we've agreed for Janie's case that a portfolio of about 60% equities, 40% fixed income, globally diversified makes sense for her plan. Investments, this is where you would identify the investment funds, ETFs, any type of investments that you're using as part of this IPS. This is where you would clearly identify what investments they are. And for Janie's case, we're using a sample portfolio from Dimensional Fund Advisors with about 60% global equities and 40% fixed income. The next part of the IPS, in my opinion, is the most important part, and it identifies three things. It identifies the historical annualized return of the portfolio. It identifies the best and worst 1, 3, and 5 year time horizons in terms of performance over the time frame that we have available. It shows also what we assume that the portfolio will return on an annualized basis in our financial plan. So in Janie's case, the performance of a similar portfolio going back to 1994, so about 30 years, is 7.66% per year annualized on average. That doesn't mean that the portfolio returned that every single year. That's an average over the time span. The interim period between 1994 and 2024, saw quite a lot of volatility for this portfolio. Now, this is a balanced portfolio, but anyone with even a short memory of markets going back to 1999 to 2008 to 2020 when COVID hit, we saw fairly steep drawdowns in even balanced portfolios. So we need to outline what that is so that when it occurs in the future, when similar volatility occurs, that Janie, in this case, we can come back to this document and say, yeah, Janie, the market's volatile, but this is inside of the historical record in terms of what we've experienced. So if your plan hasn't changed, I recommend that we stay the course. We can review the plan and update it, but if the plan remains intact, if the plan hasn't changed, my recommendation generally in these moments is not to change the portfolio. So in the case of this, a similar portfolio to the one that we've outlined in this IPS, we really focus on the worst 1, 3, and 5 year periods because that's really the dangerous points where people tend to make mistakes is at those negative volatility times. But a 60% equity, 40% fixed income portfolio had a worst 1 year return of 25.47%, a worst 3 year annualized return, so over a 3 year period of negative 6.62% per year. And there have even been 5 year periods where a portfolio of 60% equities and 40% fixed income had a negative return of negative 0.11%. Now, there weren't any 10-year periods with negative returns. Otherwise, I would have included them here. But really, we spend a lot of time on this chart and this to me is what the IPS is for, is to come back to in those moments and say, look, we're going through volatility. We've gone through similar volatility in the past. The goals for the portfolio, I can go back to them and say, okay, this money is for retirement. It's meant to last 30 years. And hopefully the combination of those things helps us kind of zoom out and gain perspective and hopefully help us avoid making a mistake at a critical market turning point. I'm going to move through the rest of the document fairly quickly because you're going to have access to it, but the document should talk about how the portfolio is diversified, how it is rebalanced. So rebalancing is something I'm going to cover in a future video, but rebalancing your asset allocation back to its target mix at the time that you implement it is an important practice for retirees or for any investor to make sure that you're maintaining the correct risk exposure in the portfolio. And I'm going to leave it at that because rebalancing is its own topic on its own. It should include some commentary on how often you're going to review it. So for clients of my firm, we're reviewing the portfolio at least on an annual basis, hopefully on a semi-annual basis. My investment philosophy, you can choose to include this or not, or you can use my investment philosophy for yourself. But really it's focused on investments are really meant to support financial plans. They're not abstractions. They're meant to get us towards a goal. Diversifying makes a lot of sense. Asset allocation, the blend of stocks and bonds in the portfolio is going to be a key determinant of our long-term portfolio return. Maintaining low costs, maintaining low turnover portfolios helps us keep returns. Tilting portfolios. I talk a lot about specific investment strategy in another series that I did on retirement investing. So I'm going to link to it in this video at the top. If you want to learn more about tilted portfolios, small cap stocks, value stocks, you can learn more about that in those videos. I want to keep this video as short as possible. The next one, very, very key, and I spend a lot of time on this as well, but I believe that it's impossible to gain an advantage in the market by investing, going in and out of the market because of current events or perceived threats. Like, there's something going on in the news. I think that this should cause me to change my investments. All the time when I get these questions, I said, this is not the way to invest. There's no advantage that I can see for a 30-year investor. And Janie, again, her portfolio is meant to last 30 years. There's no sustainable advantage that I can see by trying to time the market going in and out. And then finally, a line that I borrowed from Nick Murray, who's an author that I greatly admire. The dominant determinant of long-term real-life investment outcomes is not investment performance, it's investor behavior. And when markets become volatile, I will coach you. If your goals have not changed, do not change your portfolio. So hopefully you found this IPS to be helpful. It's a simple document, 2 pages, but it could mean the difference between investment success and failure and critical market turning points if you're very frightened by volatility. And hopefully it's something that you might be able to deploy for yourself and help ensure that you have a successful investment experience in retirement. If you have any questions or comments, leave them in the comments section below. I'm going to include one more note. I am accepting new clients for my firm. If you are interested in reaching out, I'm accepting probably about 3 more clients in the calendar year 2024. I don't take in many clients per year because the firm is really just me with some support from my investment back office. So I try to maintain a very high level of service for my existing clients. So I don't take on usually more than 4 clients per year. I'm in the midst of taking in 1 right now, but I have space for 2, maybe 3 more clients this year. So if you are interested in maybe talking about whether I might be a fit for your needs in retirement. There's a link below where you can book some time in my calendar. You can simply email me. I'll include my email in the description section below if you'd like to set up a 15-minute chat to talk about your situation to see if there might be a fit, or even if you just want to have a chat and benchmark your current experience against what I think might be possible for you. I'm always happy to have that conversation as well. So if you have any questions, as I said, leave them in the comments section. If you like this video and if you've watched it all the way to the end, give it a thumbs up and subscribe to the channel so that you're alerted when more videos are posted. Have a great rest of your day, and I'll speak with you soon. Take care.